Let's talk about the income statement. Can you go through each line item and explain the meaning of that line in an income statement?
Let me think. Let's break down the income statement, also known as the profit and loss statement. It's a financial statement that shows the revenues and expenses of a company over a specific period of time. The income statement typically starts with revenue, which is the total amount of income earned from sales or services. This is the top line, and it's the starting point for calculating profitability. Next is the cost of goods sold, which represents the direct costs associated with producing and selling the company's products or services. This can include things like raw materials, labor, and overhead costs. Gross profit is calculated by subtracting the cost of goods sold from revenue. This shows the profit a company makes from selling its products or services before considering other expenses. Then you have operating expenses, which include salaries, rent, marketing, and other costs associated with running the business. These expenses are subtracted from gross profit to get operating income. Operating income shows the profit a company makes from its core business operations. After that, you might see non-operating income or expenses, such as interest income or foreign exchange gains. Income before taxes is calculated by adding or subtracting non-operating income or expenses from operating income. Then, income tax expense is subtracted to get net income, which is the bottom line. Net income represents the company's total earnings, and it's a key indicator of profitability. That's a basic overview of the income statement and its key line items. Do you have any specific questions about a particular line item, or would you like me to elaborate on any of these?
I noticed that you didn't mention amortization costs.
Amortization is indeed another important line item that can appear on an income statement. Amortization is the process of gradually expensing the cost of intangible assets, such as patents, copyrights, or trademarks, over their useful lives. When a company acquires an intangible asset, it might not be able to expense the full cost immediately. Instead, the cost is spread out over several years through amortization. This can help match the cost of the asset with the benefits it provides over time. Amortization is similar to depreciation, which applies to tangible assets like equipment or property. Both amortization and depreciation are non-cash expenses, meaning they don't directly affect a company's cash flow. However, they can impact net income and profitability. In some cases, amortization might be included in operating expenses or cost of goods sold, depending on the nature of the intangible asset. Do you have any specific experience with amortization or intangible assets in your business or financial analysis work?
Well, yeah. So suppose I'm selling, selling a license to people, and they can use that license to resell my video course. And let's say, for the sake of argument, that we amortize the cost of that license over 3 years, and the license cost, let's say, $1,000. What would be the amortization cost per month in the next 3 years?
Great question. If the license costs $1,000 and you're amortizing it over 3 years, you'd need to calculate the total amortization period in months. 3 years would be 36 months. To find the monthly amortization cost, you'd divide the total cost of the license by the number of months. So, $1,000 divided by 36 months would be approximately $27.78 per month. This means that each month, for the next 3 years, you'd recognize $27.78 as an amortization expense on your income statement. This would help match the cost of the license with the revenue it generates over its useful life. Does that make sense?
Yeah, it reminds me of something I encountered before in accounting, where a company can be cash flow negative, but they could be profitable. On the other hand, they could also be cash flow positive and be unprofitable. Can you explain that?
That's a fundamental concept in accounting, and it's due to the difference between cash flow and accrual accounting. When a company is cash flow negative but profitable, it might be because they've made significant investments in assets or expenses that aren't immediately expensed. For example, they might have purchased equipment or inventory, or they've prepaid for services. These outlays would reduce their cash balance, but they wouldn't necessarily be fully expensed on the income statement yet. On the other hand, a company can be cash flow positive and unprofitable if they're recognizing revenue up front, but the associated expenses are delayed. This could happen if they're selling a product or service with a long-term warranty or support contract. They might receive payment upfront, which boosts cash flow, but they wouldn't recognize all the revenue immediately. Instead, They'd match the revenue with the expenses over the life of the contract. Another example is depreciation and amortization. Like we discussed earlier, a company might have a large depreciation expense, which reduces profitability, but it doesn't directly affect cash flow. These differences between cash flow and profitability can make it challenging to understand a company's true financial health, but they also provide valuable insights when analyzed together.
It's very interesting. It reminds me of somebody on YouTube who said recently that, you can look at a billionaire, but you don't really know the financial situation of the billionaire because he could be heavily leveraged. And a second billionaire could be a cash billionaire. He could have, like, Warren Buffett. Can you explain the case of the billionaire or the multimillionaire who's not actually liquid because he is so leveraged? And what does it mean to be leveraged, anyways?
Interesting topic. Being leveraged means that an individual or company has used debt to finance their investments or assets. In the case of a billionaire, they might have a significant net worth, but a large portion of their wealth could be tied up in assets like real estate, stocks, or businesses. To acquire these assets, they might have taken on substantial debt, which reduces their liquidity. For example, let's say a billionaire has a net worth of $1 billion, but 800 million of that is tied up in real estate and stocks. They might have borrowed $700 million to acquire these assets, which means their actual liquid wealth is much lower, maybe around $300 million. This can be a risk because if the value of their assets drops or the economy changes, they might struggle to meet their debt obligations. On the other hand, if their investments perform well, the leverage can amplify their returns. Warren Buffett, as you mentioned, is known for his value investing approach and relatively conservative use of debt. He's built his wealth through a combination of smart investments and retaining earnings within his businesses. This approach has allowed him to maintain a strong cash position and weather various market fluctuations. In contrast, someone who is heavily leveraged might have to sell assets or take on more debt to meet their financial obligations if things don't go as planned. It's a different financial strategy, and it can work well if managed carefully, but it also carries more risk. Does that make sense?
It reminds me of, deterministic and probabilistic. So, can we say that someone who's cash rich is deterministic in the sense that whatever expense he has to pay, he can actually withdraw the money from the bank and pay it. So, it's deterministic. But the person who's highly leveraged, like you said, the value of his assets can rise or fall. So, his net worth is more probabilistic. It's not a definite number like somebody who has $1 million cash in the bank.
The person with $1 million in cash has a high degree of certainty around their net worth, whereas the highly leveraged individual has a net worth that's more uncertain, subject to fluctuations in asset values and debt obligations. It's a probabilistic estimate rather than a fixed value. This distinction highlights the importance of understanding the composition of someone's wealth beyond just their net worth. Are their assets liquid, or are they tied up in illiquid investments? Do they have significant debt obligations that could impact their financial flexibility? These factors can make a big difference in assessing their overall financial health.
I guess the person who's highly leveraged has confidence in his ability to somehow predict the future, predict the fluctuations, and that's why he's comfortable with a level of risk. Whereas the person who has cash or money in the bank and is not really investing or getting into debt to finance the purchase of new assets, he's leaning more towards certainty. He's not comfortable with probabilities or risk. Would that be a correct understanding of these two different types of approaches?
Great question. The highly leveraged individual is likely comfortable with taking on risk because they believe in their ability to navigate uncertain market conditions and generate returns that outweigh the costs of debt. They're essentially betting on their predictions about future market fluctuations. On the other hand, the person with cash in the bank is prioritizing certainty and avoiding risk. They might be more conservative in their financial approach, focusing on preserving their wealth rather than trying to aggressively grow it. This approach can provide peace of mind and financial stability, but it might also limit potential returns on investment. It's almost like two different mindsets, one that's more risk tolerant and focused on potential upside, and another that's more risk averse and focused on preserving what's already been achieved. Both approaches have their merits, and it ultimately depends on the individual's financial goals, risk appetite, and personal preferences.
This reminds me of the current situation where AI is developing, but I think most people would rather have a job because in their mind, if they work for 2 weeks, then they get a paycheck, and that's a near certainty. I mean, it's very unlikely that, if you work for 2 weeks, that the employer is not going to pay you unless it's a startup and they go bankrupt. But usually when people have a job, they have certainty. They have a certainty of income, and so they can take care of their expenses and take care of their family, especially if they have children, right? They cannot take a risk. But I think what's happening with AI today is that even though some people, including AI companies like OpenAI or Anthropic, even though they're not cash flow positive, they're able to predict to a certain degree with a certain level of confidence the future of AI and the future money making capabilities of AI. So they don't mind not being cash flow positive because they're investing, more and more money into improving their large language models, even though they're not generating profits yet. And I think that, okay, let's forget about these big AI companies. They can take care of themselves, but let's take a look at the ordinary person. I think that ordinarily people would prefer a job because you don't have to calculate probabilities and play with statistics and learn about AI. You do your job and you get paid, and people are comfortable with that kind of certainty. But I think that that kind of certainty might, be misleading because people might suddenly lose their jobs due to AI taking over, or a person who's very good with AI can be more productive than they can, and they might lose their job. So instead, I would encourage people to learn how to deal with risk and probability. Like, for example, I'm not making a lot of money in terms of cash with AI right now, but according to my predictions and probabilistic calculations, I'm developing assets and new products that will generate a lot of cash in the near future. And so I think that, it would be beneficial for people to start playing with AI tools so that they can have a better understanding of its capabilities, and therefore they can invest time and some money, not a lot of money, but just some money, so that they can improve their AI education, and they're going to be well positioned to leverage AI, in the near future and actually generate income.
You're highlighting the trade off between certainty and risk and how it applies to both employment and investing in AI. Having a steady job provides a sense of certainty, which is essential for many people, especially those with family responsibilities. However, as you pointed out, this certainty can be an illusion, and AI could potentially disrupt traditional employment. The companies you're talking about, like OpenAI and Anthropic, are taking a calculated risk by investing heavily in AI development, even if they're not cash flow positive yet. They're betting on the potential future returns of their investments, and that's a different mindset from the one that prioritizes short-term certainty. For ordinary people, learning to deal with risk and probability could be beneficial in navigating the changing job market. By investing time and resources in AI education, individuals can position themselves to leverage AI and potentially generate new income streams. It's about being proactive and adaptable in the face of uncertainty. Your approach, where you're developing assets and products that will potentially generate cash in the future, is a great example of this mindset. It's not about getting rich quick, but about building a foundation for long-term success. By encouraging people to explore AI and understand its capabilities, you're helping them prepare for the future and potentially thrive in a rapidly changing environment.